I'm the warm-up act, so we got to get a little bit more enthusiasm here. Good evening, everyone.
Yay!
Okay, we're going to get this going for David. In addition, what really makes a great business school is also what you would expect. Things like great students, great faculty, but what really makes great business schools is great alumni. And getting alumni involved is a priority for us. And your alumni association over the last 2 years has initiated a number of new activities. This included also the last lecture series, and I know a number of you came to that for Professor Render and Professor Higgins. So those are the kind of things that we are doing to re-engage you, our alumni, an important resource not only to our current students, but also to our reputation in the community, because you become advocates for everything that we do. Seeing as Kevin mentioned jobs, I will tell you that if you find that you or one of your colleagues who are alums find yourself in hard times at the job, is our alumni are now eligible to use the services of the Career Management Service. And so what we've actually been actively involved in helping alumni find jobs when they found themselves unemployed. And so make sure you tell your classmates and others that if the unfortunate does happen, we're one of your resources to help make things happen. Tonight's presentation is going to be on the banking crisis. It's going to be presented by Professor Currie, who many of you have had in the program. One of the things that I and the other alumni people do is we travel around to alumni events all over the country. And one of the questions we like to ask is, tell us about some of your favorite professors. And Professor Currie is almost always one of the names that gets mentioned when we're on the road, because he's left quite an impression, not only the grades, but I mean, more importantly, it is indeed his passion for learning and his passion for teaching and the passion for his topic. I will tell you that tonight's presentation is being podcasted or videocasted or something like that, so be careful what you say. And we also have to be very careful because we're also sending this directly to NBC because they're considering Professor Currie for Conan O'Brien's slot. David is a wonderful colleague on the faculty. He's an amazing faculty member, and I'm not going to go into a lot of details, but he didn't give me anything. He said, just say, here's David. But I will tell you that David has been here for over 30 years. And that indeed is a statement of his commitment to Crummer and to the many students we've had. So without any further ado, David.
Thank you very much for coming. It's a different crowd than I thought was going to be here. I was expecting maybe 2 or 3 people to show up. But it's nice of you to come, and I certainly appreciate it very much. We're going to talk about the banking system tonight, and I'm going to do it by talking about some threads. But before we do, we're going to have a pop quiz. So what I'd like for you to do is try to answer these 5 questions. And you can talk to your neighbor if you want to verify your answer. And I've even got a couple of prizes here for whoever gets the answers correct. So let's see. Question number 1 is, who was president when the Federal Deposit Insurance Corporation was created? No, we're not going to answer now. I'm going to talk about this, and you'll get the answer during the quiz. I mean, Okay, so that's the first one. Who was president when the Resolution Trust Corporation was created? Well, there's already some murmuring in the audience. Who was president when the government took control of Fannie Mae and Freddie Mac? More U.S. banks failed in the year 2009 than failed in which of those years? 1933, 1989, or 2005, or none of the above? The Bank for International Settlement surveys the derivatives market every so often. And what is the total amount of derivatives in the world these days, do you think? So those are the 5 questions in the quiz. Remember it. And later on, we'll see how you did. So what I'm going to talk about tonight are 5 threads. And these are 5 threads that occurred to me. You might have some other threads that you've been itching to talk about the banking system. And if that's the case, then be sure to talk about them at the end, because at the end I'll give everybody a chance to mention some things. And if there's a topic that you want to talk about, then be sure to bring it up. I may ask you to answer your own question if you ask a question, because you probably know more about that thread than I do. But these are the threads that occurred to me. And we're going to do this by examining the financial statement of a bank. And this is a bank that's not very familiar in Florida, called Wells Fargo Bank. But it's going to be more familiar in Florida because they just purchased Wachovia Bank. And now Wells Fargo is the 2nd largest market share in Florida banking. So you'll know more about it. When I lived in California, I used to bank at Wells Fargo, and I loved their checks, because their checks always had the stagecoach and the equestrians team, or equipage, that's what it's called, equipage team in front of the and so I used to love to write checks. Man, I wrote checks like butter, and I got a lot of comments on them, and usually it was because of insufficient funds, but but it was great to write those checks with all of that stuff in there. And what we're going to do is we're going to look at the financial statement of Wells Fargo Bank, and this is their financial statement. It's a big bank, $1.3 trillion. Notice how big that is. And you better get accustomed to banks that are that size, because the top 4 or 5 banks in the United States now are more than $1 trillion in size. And I read an article recently that said that the top 4 or 5 banks in the United States have a market share of about 70% of all the banking in the United States. So the United States is becoming a very concentrated banking country. We used to be spread out, and each county in Florida, as a matter of fact, used to have a separate bank because we had a unit banking system. But now it's all consolidated, and banks are spread around the United States. The first thread is the thread about comparing deposits, which are over here on the liability side, to the amount of cash that the bank has. And many people are under the mistaken impression that a bank keeps your cash inside the bank. And that's not true. That's never been true in the banking system. And long after this financial crisis passes, then it's still going to be true. A bank doesn't keep your money in the bank. A bank does other things with your money. It invests it so that it can earn interest, or it lends it out so that it can earn interest, because that's the way a bank makes profits. You'll notice that, what's that percentage? That percentage is only about 3 or 4%, so that's not very much money. What happens when there's a financial crisis? Anybody got an answer to that? What's the first thing people do? They try to take their money out of the bank, don't they? Yeah. And you can see that it doesn't take very much money before the bank runs out of cash, does it? Because with $780 billion of deposits and only $24 billion in cash, then you don't have to have many people come to take their money out of the bank. And this is a picture of a bank run. This is a bank called IndyMac, which was out in California, and it was one of the banks that failed in the United States last year. And so all the depositors are lined up there ready to take their money out of the bank because they're afraid. So what has to happen when people try to take their money out of the bank? Well, 2 things happen. The first thing is that the Federal Reserve has to put money back into the banking system, because people are taking money out of the banks, and in order to keep the banks going, the Federal Reserve has to put money back into the banking system. And over the last year, the Federal Reserve has put about $1.7 trillion into the banking system. So that's how much additional cash the Fed has pumped into the banking system in an effort to keep the banking system going. I forgot the next point I was going to say. I'm trying to do this without my notes here, and I forgot the next point. Well, I'll skip it. I'll come back to it if I think about it. The next thing that happens is that the Federal Deposit Insurance Corporation was created back in 1933 under whose administration? Roosevelt, under the Roosevelt administration. And the Federal Deposit Insurance Corporation, whenever there's a problem in the banking system and the bank runs out of money, then the FDIC steps in and takes over control of the bank. And the FDIC then tries to sell the bank to somebody else, to a different bank. And what happens is the FDIC pays cash to the new bank in exchange for all of the deposits that are insured by the FDIC. And then the FDIC tries to sell off all of the other assets that belong to the bank that failed. So that a bank might try to sell loans, or they might try to sell securities, and whatever the difference is between what the FDIC had to pay in cash for the insured deposits minus whatever they make up for by selling the other assets in the bank, then that's what represents the hit to the FDIC. And the FDIC has done a great job at maintaining confidence in the banking system. Because when it was created in the 1930s, it was a terrible situation for the banks. Anybody know how many banks failed the year before the FDIC was created? The FDIC law was passed in 1933, and so it started business in 1934. And in the year 1933, 4,000 banks failed in the United States. The very first thing that Franklin Delano Roosevelt did when he became president was to close all the banks of the United States. Every bank. He said, we're going to have a bank holiday for a week. And then that Friday, he went on the radio. This was the days before television. He went on the radio and had his first fireside chat. And his first fireside chat was to try to restore confidence in the banking system in the United States. He said to the people of the United States, listen, we're closing the bank, but when the banks open next Wednesday, everything is going to be fine. All your money will still be there. The only difference is now we will have a better handle on what the problem is and what we need to do about the problem. And that restored confidence in the banking system in 1933. And the FDIC has done a good job maintaining confidence in the intervening, 77 years now. There was another banking crisis in the United States a mere 20 years ago when the savings and loan industry failed. And when the savings and loan industry failed, we had another rash of bank failures. There were about 530 bank failures in the year 1989. Last year, anybody know how many banks failed in the United States in 2009? I looked at the FDIC's homepage and it was 140. So 140 banks closed during the year. And so only 2 years in the entire period since the FDIC was created until now, only 2 years were years that no banks failed. And one of those years was 2005. So the answer to that particular question on the quiz was more banks failed in 2009 than failed in 2005, because 140 failed last year, but only 0 failed in 2005. So the two things that happen whenever there's a financial crisis and people try to take their money out of the banking system are that the central bank in turn puts money back into the banking system, and in the occasion where a bank still fails, then the FDIC steps in and assumes control of the bank. So that was thread number one. Here's thread number two, and thread number two is to compare the bank's loans and securities, which is about $1 trillion over there on the asset side, to the bank's equity, which is less than $100 billion, $99 billion. And you can see that it doesn't take very much change over on that side for it to affect the bank's capital over here, because the bank's capital is the ownership interest in the bank. It's called either capital or owner's equity or whatever you want to call it, but it amounts to the owner's investment in the bank. And if that number goes down over there by 10%, then it wipes out the entire capital position of the bank, doesn't it? Anybody know what's gone on over the last year? For example, what's happened in the securities market? From the peak of the securities market until the trough of the securities market, wasn't the change about 40%? So when the securities market prices went down drastically, I thought the bells of heaven were ringing for me, Nate. Yeah, so it doesn't take very much change. Now that doesn't particularly affect commercial banks, because commercial banks generally don't invest in securities like stocks and corporate bonds. But it does affect a different section of the banking system called investment banks. And one of the things that you have to do is divorce yourself from thinking that what goes on here in Winter Park, Florida, is what goes on in the same banks up in New York or Chicago or Los Angeles, because that's a totally different breed of cat. Those banks up there are the big money center banks. They don't do the same functions that we do here in Winter Park. And so commercial banks, like the ones we would bank here in Winter Park, they don't invest in securities like common stocks. But the banks that are big investment banks, or they have a bank holding company that has an investment banking division and a commercial banking division, they do those kinds of investments. And so when the securities portfolio goes down 40%, that has a terrible effect on the bank's capital, doesn't it? And the other thing is that not that just the securities went bad, but a lot of the loans went bad. And foreclosures in the United States have really been terrible. There was a speculative bubble in 2008 and 2009, and people around the world were buying stocks and bonds in the United States. They were buying properties in the United States. They were buying all kinds of assets in the United States. So that inflated the speculative bubble. And then when the banking crisis hit, everybody wanted to get out, and so the bubble deflated, and that led to things like foreclosures. And I think there are something like 10 million properties foreclosed in the United States right now, where I said that wrong. There are 10 million properties where the value of the property is less than the mortgage on the property. And so who has an incentive to stay with their property when the amount that they owe on it is more than the amount that the property is worth? So we had securities going down, we had the loan portfolio going down, and the net result was that the bank's equity was decreasing, because when things change on the asset side, you've got to deduct it from somewhere, and the place where you deduct it is on the bank's equity investment, the capital of the bank. So bank capital was going down. Speaking of the mortgage meltdown, the holders of the mortgages, the two big holders of the mortgages, were Fannie Mae and Freddie Mac. And so back in the Bush administration, George W. Bush, this is the younger Bush, the Treasury took control of Freddie Mac and Fannie Mae. And a lot of people don't like that idea, because they think, well, the government of the United States really should not be in the business of owning financial institutions. And that's a philosophical issue. But in reality, it kind of calmed markets, and ever since the government has intervened, then maybe it's not such a bad idea in retrospect, but we'll see. Another thing that was created during the George W. Bush administration was the Troubled Asset Relief Program, nicknamed TARP. And the Troubled Asset Relief Program is modeled after a similar program that his father adopted back in 1989, George Bush, and it was called the Resolution Trust Corporation. And the idea behind both of these organizations, the Resolution Trust Corporation and the Troubled Asset Relief Program, is let's start an organization, and this organization is going to be responsible for buying all of the bad loans that the banks have on their books. Because the idea for the banking system is to get the funds flowing again. And the best way for us to do that, the rats are leaving the sinking ship already, aren't they? The best way to do that is to take the bad loans off the books of the banks. And so that's what the RTC and what TARP did. It took the bad loans off of the banks, off of the books of the banks, so that the banks then didn't have to worry about the bad loans. Now they had cash that they could start lending again, in theory. That's the theory behind it. Banks aren't necessarily doing that, are they? When the RTC was passed back in the savings and loan crisis, the estimate was it was going to cost about $500 billion, half $1 trillion, to resolve the savings and loan crisis. And it turned out that it didn't cost nearly that much, because the RTC took the bad loans off the books. It quickly started to sell the loans to other parties, and so it was rejuvenating cash. And so it actually made a little bit of money on some of the loans, but many of the loans were sold at tremendous discounts. So if you happened to be in the market back in those days, you could have made a good profit by buying from the RTC. And the same with TARP, because they're trying to market the loans from TARP. A lot of the properties are selling for more than the value of the loan, and so TARP is making a little bit of money on those. But generally, TARP is not there to make a profit. TARP was created to try to get the loans off of the books of the banks. Now, if you think that that was a bad idea, to create an organization and get the loans off the books of the banks, compare what's happening in the United States right now to what happened in Japan 10 years ago. Because Japan faced the same issue, and they didn't create an organization like the RTC or TARP. And as a result, the banks in Japan have been saddled with bad loans for a decade. And does anybody know what the economic growth of Japan has been over the last decade? Zero. It hasn't done anything. Japan is an economy that's stagnating, and one of the reasons is because those bad loans stayed on the bank's books. Okay, what are we on now? Thread number 3. And thread number 3 is banks are good at using leverage. Leverage is where you put in a little of your own money and you use a lot of other people's money. And you'll notice that the bank own money the ownership money is only $99 billion, but that's used to finance $1.3 trillion in assets. So that's leverage at its best, isn't it? This is about 7.5%, I think it turns out to be, for Wells Fargo, and that's typical of banks around the world, not just in the United States, but around the world. These things called capital standards, that's the 7.5%. The capital standards are set by the central bank and by the treasury of an individual country. So that means that in the United States, the Fed and the comptroller of the currency are the ones who set the capital standards for the banks here in the United States. But around the world, banks have been trying to coordinate capital standards everywhere. And so there's kind of a central bankers focus group or a central bankers clearinghouse that's called the Bank for International Settlements. And the Bank for International Settlements, one of their tasks right now is to try to make sure that banks around the world have similar levels of capital, because if a bank has a different level of capital, then it has a different amount of leverage, and therefore it can magnify its return by doing certain things. So what the Bank for International Settlement tries to do is make sure all of the standards are the same. The way it's been trying to do this is it says to the banking system, well, you have to have a certain amount of capital depending on the kinds of investments that you make, depending on what your assets are. So that a bank that invests in assets that are very safe, like let's say government securities, those tend to be very safe, might not be required to have as much capital as a bank that invests, as a bank that makes a lot of loans, for example. So a bank with a safe portfolio would have a little capital. A bank with a risky portfolio would be required to have a higher level of capital. That sounded good to them, because that was the model for the banks to kind of self-regulate their own performance. But now that this financial crisis hit, I think they're probably going back and wondering whether they actually chose the right numbers, because the banks have started to run low on capital, not just in the United States, but around the world. This is a worldwide financial crisis. And because the banks are running low on capital, then the Bank for International Settlements, I think, is probably going to up those numbers. Another thing that happened under TARP is that TARP was an act that was passed by Congress, and Congress allowed the Treasury to purchase ownership in a bank. So not only did TARP allow the banks to did the act allow TARP to buy the assets, but it also allowed the Treasury to invest in a bank by purchasing shares of stock in the bank or purchasing preferred stock in the bank or purchasing warrants that would enable the Treasury to purchase shares of stock in the future. And this part has been very successful, believe it or not, because the original estimate was that it was going to cost the Treasury about $75 or $76 billion because of the amount of capital that was putting into banks. And it turns out that instead of losing $76 billion, they're actually making about $19 or $20 billion. And the way they're making money is because when they bought into the banks, what were the share prices? Pretty cheap. Somebody outside was talking about 50 cents. Who was that? Was that your bank? Okay. So 50 cents a share, so that's pretty cheap. And but once the financial system gets improved and things are better, then TARP can in turn sell the shares of stock and make a profit on it. And so instead of losing money, it's actually making money on this aspect of the Troubled Asset Relief Program. Now this is the fourth thread, and this thread is something that doesn't appear on the financial statement, doesn't appear on the balance sheet of Wells Fargo. This is called an off-balance sheet item, and this is derivatives. Look at the number there for just a second and tell me how much that is. $5.4 trillion. What's the GDP of the United States right now? About maybe 15 or 16 trillion, let's say. So in other words, here's one bank, Wells Fargo Bank, which has derivative contracts that are equal to about 1/3 of the GDP of the United States. And this is only one of the 4 or 5 large banks, so if you add those all together, then it makes a big number. So that's one thing I want to stick you with is the size of the derivatives market. For those of you who don't know what a derivative is, it's one of those financial contracts like a forward contract or a swap or a futures or an option that allows you to lay off the risk to somebody else. So for example, if I'm exposed to risk from doing something, then I might be able to shift the risk to Laurent because Laurent will assume the risk in exchange for me paying him for assuming the risk. And so that's the way these contracts work is I can push the risk off to somebody else in exchange for me paying for it. Now what does Laurent do? Well, Laurent just passes the risk on to somebody else and the risk gets shifted down the line, but does it ever disappear? It doesn't, does it? It just continues to be shifted down the line, but it doesn't go away. So there's always risk out there in the financial system because of derivatives. And you've all heard of Warren Buffett, haven't you, the famous financier? He said derivatives are a time bomb that's just waiting to go off. So that's his attitude about derivatives. One particular derivative played a crucial role in the financial crisis, and that was a credit default swap. A credit default swap is up there at the top where it says swaps. This is a particular kind of swap. And this is a swap where I would pay somebody, and they would agree to reimburse me if a loan went bad. So a prudent banker would make a loan and then buy a credit default swap that would insure against the loan going bad, and to the banker everything was fine. And so credit default swaps were very popular for the last 4 or 5 years. But because the risk just kept shifted further and further down the line, eventually it reached an end point, and the end point was this corporation called American International Group, AIG. And AIG just happened to be the biggest issuer of credit default swaps at a time when the loans were going bad. So as a result, they were responsible for reimbursing banks for all of their bad loans. Well, AIG didn't have that kind of money. So as a result, that was a strategically located financial institution that if it went bad, it would have repercussions not just in the United States, but around the world, because banks around the world were buying these credit default swaps. And for that reason, the Treasury Department decided, well, they shouldn't allow AIG to go bankrupt. So what the Treasury did was they purchased ownership in AIG, and now your federal government owns 80% of this organization. So that's a strategically located bank because of its position in the credit default swap market, and you own it. Now, the fifth thread is regulation. And this is another topic that's not related to the financial statement of a bank, but it's a topic that we really need to talk about, because all of those derivative contracts that we just talked about are totally unregulated. Anybody have any idea what the total derivatives market is around the world? The highest number? $680 trillion. That's right. The Bank for International Settlements conducts a survey every couple of years, and the last survey said that about $680 trillion was the amount of derivative contracts that were out there. It's an amazing number, isn't it? That's something like 10 times the world's GDP. And it's all financial contracts that are just waiting out there, waiting to get resolved. And it's a totally unregulated market. Some derivative contracts trade on centralized exchanges, such as the Chicago Mercantile Exchange, for example. But other derivative contracts are just face-to-face, over-the-counter contracts between one party and another party. And that's why the Bank for International Settlements has to estimate the number rather than giving us an exact number about the amount of derivative contracts. The Financial Accounting Standards Board came up with standards about how the American banking system could regulate derivatives here in the United States. And so they testified before a committee in Congress, and what did the committee decide to do? Nothing. Nothing. They just left it like that. There was a good article in last week or the week before Business Week about who really runs the financial regulation, and it's not Congress. Who really runs financial regulation? The banks. Yeah, so if you get a chance to read that, it was in Business Week about 2 weeks ago. Another thing that's not regulated is internet banking. And I guess a better way to say this would be to call it internet lending. Internet banking is fine because that's where I can do stuff over the internet rather than having to write those Wells Fargo checks with the cute coaches on there. But now I can do it all on computer. But internet lending is something different, and that was a market that grew over the last decade or so. Because in the old days of banking, it used to be that the banker would do everything by sight. I know you, I shake your hand, therefore I give you a loan. I can see what you're going to do with the money, and if it's someplace that I can't see it, then why in the world am I lending you money? But how does internet lending work? You just type in the numbers, and nobody ever sees you. Nobody ever sees what you're using the money for. It's just all numbers that are typed into the computer. And this led to a lot of abuse, didn't it? Because there were some people who were too poor to buy a house, and they ended up being able to buy a house. There were some people who could afford to buy a house, but because of the way they were able to massage the numbers, they bought a bigger house than they could afford. We got some people who used to be in that business because I used to be a client of Countrywide, and I used to get mailings every day from Countrywide asking me to renegotiate my loan, refinance my loan, do something so that they could turn a quick buck on it. And I tried to resist those as much as I could. Oh, the point I probably ought to close with about internet banking is that because we can't do away with the internet, we certainly are not going to do away with internet banking, but maybe we need to have some kind of regulations that would start to regulate the amount of lending that goes on in a way that's through computers rather than face-to-face lending. Here's another issue about deregulation, and that is this trend toward deregulation. Because back when Ronald Reagan was president, he started the idea of deregulation, and that's been really carried to extremes in some aspects. One of the aspects is in the banking industry, because the Federal Reserve and the Treasury have tried to set up systems where banks regulate themselves. so that it's built into the system rather than the regulator coming by and making sure that all the financial statements say what they're supposed to do. And that hasn't always worked so well. We're finding out, for example, that some regulators, some of the people in the banking industry who were in the regulatory branches, would go to a bank and they would find errors in the bank's accounts, or they would find banks' practices were not what they should be, and instead of doing something about it, their attitude was, well, we're trying to deregulate the banking industry, so we won't do anything about it. Or they found something and they took it to their supervisor, and the supervisor said, well, let's start a proceeding where we investigate this bank further. And a member of Congress or a senator or somebody from the executive branch stepped in and tried to get the person to not regulate the bank, not examine the bank. And so with that kind of interference, then this idea about deregulation is not such a good idea. A financial system is an important part of a country, and it needs to have a certain amount of supervision over it and regulation to go along with the supervision. There was a famous act, the same act that created the FDIC back in 1933, the Banking Act, also was called the Glass-Steagall Act. That's another name for that same act. But what it did was it said, something bad happened here in the Depression. And what happened was some banks were taking the money that they would get from depositors, and they were turning around and speculating with it by buying corporate stocks and bonds. And so the Glass-Steagall Act put a wall between those two. It said, from now on, we're going to have one kind of bank called a commercial bank that's responsible for taking deposits and lending money. Then we're going to have another kind of a bank called an investment bank that's able to speculate in stocks and bonds. But they can't get deposits. They can't accept depositors because the deposits are over here on this side. Well, that was the way the banking system operated for 50 or 60 years until maybe the late 80s or early 90s, and gradually the central bank, the Fed and the Treasury and all the regulatory agencies started to break down these walls between commercial banking and investment banking. And so now the big New York City banks are in a position where they've got a bank holding company that has both of those activities, and unless they are very strict about it, then it's conceivable that they could take money from depositors and use it to speculate in the stock market and bond market. And some people think that that's what has been going on. Then the last point is about the independence of the Federal Reserve. When the Federal Reserve was created back in 1913, it was created so that it was independent of the executive branch and the legislative branch of the governments. It was created to be its own entity outside of the political sphere of the government. And that turned out to be what I think is a great idea, because an independent central bank is the right way to run a country. I can't imagine anything worse than what's going on right now, which is the talk about making the central bank report to Congress. Can you imagine politicians being in charge of the monetary policy of the United States? Or can you imagine they've done such a bad job with the budget of the United States, and our national debt is as bad as it is, to put them also in charge of monetary policy would just be absolute folly. That would be the end of the United States as a developed country. The guy's name who's fighting the battle the hardest is Ron Paul. Have you heard of Ron Paul? He advocates doing away with the Federal Reserve. Maybe there are some good arguments that he's got there, but his position is do away with the Federal Reserve. And so he introduced an act which did get passed, and that is the Congress is going to now start to audit the books of the Federal Reserve more closely than it used to. So there's a little erosion of the Federal Reserve's independence, but I hope there's no more. The trend around the world has been to make central banks independent of the government. So the Bank of Japan, the Bank of England, banks around the rest of the world, central banks have been independent of the government, And now the United States is starting to go back the other direction. Okay, how many of you had Franklin D. Roosevelt for the answer to the first one? Okay, that was the easy one, right? Okay. Did any of you know that George Bush was the guy? Okay. He started the Resolution Trust Company. And did you realize that George W. Bush was the president when they assumed control of Fannie Mae and Freddie Mac? Yeah. The reason I ask these questions is why? Well, first of all, it does put it in perspective and give us a timeline, because these things have gone on before in United States history. But really the reason I ask the question is because who do most people blame for the banking crisis right now? Barack Obama, don't they? The current president. When in reality, he inherited the problem, and presidents before him had already taken steps to try to solve the problem. He's just doing whatever he can right now to take over the problem, to solve the problem. Okay, and the answer to this one was C. Did anybody get that one? A few of you did? Oh, good. You must have had a good economics teacher, sir. Yeah, well, this was something that we wouldn't have talked about in my economics class, because and 680 trillion. I noticed that a few of you said you got that. Anybody get all 5 of them correct? Only one person in the whole room got all 5 correct? Well, our gracious alumni office.
There you go. There you go. Thank you. All right.
And let me try to summarize your question again. Is there going to be an increasing trend towards government ownership of the banking industry? Regulation, or is this something that will go away? Yeah, and my answer to that question is there probably will be different kinds of regulation, because it's shown that the existing regulations don't work. So the kinds of regulations are probably going to change. One of the issues that you talked about was how to regulate the derivatives market, or how to tax the derivatives market. And taxing the size of a bank doesn't address the issue of trading in derivatives. So what's going to happen is somebody's going to have to zero in on whatever aspect is they think that's a bad characteristic and find a way to either tax that or regulate that. Paul Volcker is one of the most outspoken people about that right now, because Paul Volcker used to be the chairman of the Federal Reserve years ago, and now he's one of President Obama's advisors. And he says that we've got to change the kinds of things that we regulate in the banking system. And so he's true. I don't know whether I answered your entire question, Kevin, because your point is that Congress is not really addressing the issues. All they're doing is trying to find somebody that they can fire a gun at and blame for the financial crisis. And that's absolutely right, because politicians get elected and they get famous by pointing guns at people and saying, well, here's the cause of this, and we're going to get that person out of office. But what it takes a prudent politician to do is changing the way that the banking system is regulated, and that's a much tougher issue. And that's fraught with political issues, isn't it? Yeah.
My question, I want to understand the economics of the value of the assets, excuse me, that you posted for Wells Fargo. It was like 1.6 or 1.4 trillion versus the value of the derivative transactions was like 5 times that, or 5.4 trillion. If I understand a derivative transaction, how can their value of their derivatives, I guess that would be a mark-to-market value at that point in time, be 5 times that of what their assets is?
Well, remember, derivatives don't appear on the balance sheet like loans and securities do. So just because one number is 1.4 doesn't mean derivatives could be any number it wants to, because derivatives are an off-balance sheet item. They're not required to be reported by most countries around the world. In the United States, banks do report their derivatives position, but it doesn't have anything to do with the assets or liabilities of the bank. So that's a brief answer to your question. The rest of it is that I was a little bit misleading, because I wanted to make it sound like a dramatic number, $5.4 trillion. In derivatives parlance, that's what's called the notional amount. Have you ever heard of the notional amount of a derivative? Because a lot of derivatives are a made-up number. For example, if you have a fixed versus a floating rate swap, then the only thing that matters is the fixed and the floating rates of interest, interest payments that you make, but you've got to base the interest on some amount, and that's called the notional amount, and that's made up. That sounded like it was a great idea not to worry about notional amounts until AIG happened, and then all of the notional amounts ended up at AIG. And so maybe notional amounts are something that we need to worry about. But actually, if you look at the derivative statement that's presented in Citigroup or Wells Fargo's financial statements, they net the amount that's the exposure of the bank. This is the amount we've got going out, this is the amount we've got coming in, or this is the amount that's subject to interest rates going up, this is the amount that's subject to interest rates going down. They take the net of that, and that's called the net position. And I didn't do that because it's not as dramatic as 5.4 trillion.
Ratings agencies. I didn't mention anything about the ratings agencies, and there's speculation about the coziness that the ratings agencies have with the banks and why they're not more independent. They're getting a better valuation, a better appraisal of the packaged mortgages that are packaged with the securities. I want to hear your thoughts on the ratings agencies. And then I also want to point out that in following everything with the Wall Street Journal, it was apparent that when the subprime mortgages were packaged and bundled together, and then the rating agencies gave them the ratings, the people that would get claims to them first were given a triple A position. And so you're looking at a triple A position on something that's very risky, and we're finding out perhaps not worth as much as people thought. So why would someone be given a triple A rating on something that may have been worth owning, for example? So I heard your thoughts on ratings agencies and why AAA.
Why don't you give us your thoughts since you've got the microphone?
Thank you. I listen to Marketplace on NPR, the Wall Street Journal, regular basis online. And so ratings agencies should be independent. They should be not influenced by the banks or the investors in order to get a true appraisal of the securities that are being purchased. And so I think that should be number one, new regulation. And then number two, it's got to be clear to the investors that if you're getting something rated AAA, that it truly is a solid asset, a solid investment of AAA status, not just you get this balloon first rather than last. So,
that's great, and I couldn't say it any better. There needs to be a rating agency is there because it's supposed to give you an impartial assessment of the value of the asset, and they didn't do a good job, did they? They had too close ties with the people who were trying to get the value of the asset or the asset value. I can tell you one other thing that I'll add to it since I've been through the rating process a couple of times, and that is that as long as you buy insurance, your rating's going to be AAA regardless. Because when I worked for the city of Winter Park, we went to Moody's and Standard & Poor's, and our rating before insurance was only going to be, let's say, AA or something like that. But as soon as we bought insurance, it was AAA. But the trouble is that insurance is only as good as the company that's promising the insurance right now. And we found out that it didn't work so well with AIG, did we? Yeah, so that's the issue. But you can buy a better rating. You can buy it the right way, which is to buy insurance, or it turns out you could buy it the wrong way, which is to influence somebody who's making the assessment.
I'm not for tons of regulation, but it just sounds like the secondary market needs to be a lot more closely regulated. You know, that's where the regulation needs to be. The derivatives, the insurers, the liabilities that these companies hold, which were not regulated prior. There was no auditor going in there and saying, well, if push comes to shove, you all aren't able to pay out on all these claims. So that's really where I think we need to see more regulation.
Okay.
You had mentioned that Japan in the 80s did not create an RTC or a trust fund and that they are now lagging behind. What is it that you think regulation trends are in developing countries worldwide? What are the other countries doing to regulate the banking industry?
Well, you have to separate the world between the developed countries and the less developed countries, and the less developed countries don't count because they don't have much of a financial market anyway, do they? So we're really only talking about countries such as the United States, Germany, the UK, Japan, and those countries are doing almost the same things that the United States is thinking about right now. For example, the UK, this financial crisis hit the UK just as bad as it hit the United States, and they're proposing taxes on banks. They cut the salaries that they would allow traders in the markets to earn. And that's something the United States hasn't done yet.
But prior to the financial crisis, were they regulated more than we are, and now they're adding additional regulations, or were they more deregulated like us and just now started to add rules?
And I really don't know the answer to that question. I'm sorry, I don't know that amount of detail about those countries' banking laws.
I guess my question is, we've seen the collapse of the residential paper. However, there's this gigantic wave of commercial paper that hasn't hit yet that's about to hit. And I guess I just want to get your opinions on how you see that affecting the market in the coming year when that collapse happens. And are we going to see another round of massive bank closures, or how do you see that affecting banking?
My answer to that would probably be the same as yours is, that there's a big volume of loans that are going to go bad, and can the banking system withstand another hit like that? And I don't know, really don't know the answer to that. The thing it would lead to would be more of the kinds of steps that we've taken already to try to solve the banking crisis. And that is, the government might intervene to try to prop up some banks that were hit by those bad loans, or TARP would end up purchasing the bad loans so that they were no longer on the bank's books. But I just don't forecast the future enough to know exactly what's going to happen. No one has asked me yet about why banks don't lend money anymore.
I can tell you, because they come in blue suits and they carry big boxes and they
So
in the boardroom.
So the bank regulators keep an eye on you, huh?
That's an understatement. Yes.
I have a different answer to that question, so let me just give you my answer. Remember when we talked about the bank's financial statement, we said that capital was a relatively small amount? Every time a bank makes a new loan, it increases its assets and its liabilities, which means that that amount of capital now has to cover that much more assets and liabilities. And so banks are hesitant to make too many loans because they've only got a certain amount of capital on hand right now. And if they want to be safe, then they won't make new loans, which would create new exposure for the bank. And so the government is really asking banks to do two conflicting things. They're saying, go out and lend money to help the economy, but be safe when you do it. And you can't lend money and be safe at the same time, because a loan is a risky proposition. Okay. So he asked two questions. One question was the fact that the stimulus money has already been put aside to some degree to cover the commercial defaults that Nate was talking about.
Or do you think that is a plausible reason why the money is sitting?
I can guarantee you that that's why banks are trying to protect their capital positions, is because that they know that there's going to be more hits on the lending side. And so if there's going to go down on the asset side, they'd better have the capital to support that. So that the answer to that question is probably yes. The second question you asked was about velocity. And the velocity of money is how rapidly people spend money, and that depends on how people feel about the economy. And as people get accustomed to the economy, then the velocity is going to pick back up. We had, how long, a year and a half worth of recession, which is a pretty long recession by United States standards. But you know, the amazing thing about economies is they get better. And the United States economy will get better. It got better after the financial crisis in 1988 and 89, when an entire industry was wiped out, and it'll get better after this financial crisis. One of the problems is some of you people just aren't old enough. Because if you've been through this 2 or 3 times, you know that everything works out eventually. I might lose my job, or you might lose your job, or something like that, but eventually things are going to get better, and they will.
A little root analysis maybe on some of the cost factors before all this derivatives and everything else like that. If you start looking at back when, I can think about a lender, a banker, like you said earlier, would make a loan, that banker would look you in the eye, would look at the property and say, yes, I'm gonna make this loan, or no, I'm not gonna make this loan. Yes, you have a business proposition, no, you don't have a business proposition that will give me a reasonable risk of recovering what I'm gonna make. There's been a lot of political and philosophical change, things driven by regulation, per se, that says, if you don't make this type of loan, we shall treat you differently from another bank that does make these types of loans. How much has that impacted or been a causal factor of the problems that we're seeing today?
Your question amounts to should the fact that Congress influenced the banking system to try to make more loans to lower income people.
Correct.
Yeah.
And that's not a reality, because reality for banking is there is a analysis that says, I'm going to get a payback on this, and if I don't get a payback, if the risk level is a certain number, then I get a higher level of interest. But no, we can't do that because they can't afford that. If I make this loan to a person that doesn't meet requirements, then it's very likely I'm not going to get paid back. So all of a sudden we create a derivatives market that spreads the risk, which is an artificial market. And it's not a real market of real property, which is what a lot of loans are about, real property or businesses that have a real chance of succeeding and going forward. Therefore, when we get into these artificial markets, all of a sudden we run much higher levels of risk, and probably these banks would not have made those loans in the beginning unless they had been encouraged strongly to push in that direction. I mean, I don't.
Well, you've summarized the situation very well, so I really don't have anything to add to it. The thing that I don't know is of the problems in the lending portion, how much of it was because poor people were allowed to buy houses that they couldn't afford, and how much of it was people like you and me who bought bigger houses than we could afford. Because there were a lot of people like that out there. And I don't know what the percentages are. If you've
It's
seen
all about the choices you make and what you can afford versus what you can't afford, and whether the banks would make those loans. And a contributory factor to that is as you look at a lot of the consumer loan lending that stood behind this, because you have the real property lending and you have the consumer lending that stands behind it. As soon as you see someone that goes out and says, buy a car and don't make a payment for a year, or buy a house full of furniture, I just lent you $600,000 or $100,000 on a home that's worth $50,000, but go buy $10,000 worth of furnishings and not pay me for 2 years. All of a sudden there's irrational decisions being made.
a lot of irrational behavior.
And that
I agree.
irrational behavior takes place and doesn't come to roost for 2 years, for a year, until all of a sudden things start happening. Then it all collapses like a house of cards.
Yeah. But let me interrupt you just for a second. We've got a call here from San Diego, California.
Actually, from Nashville, Tennessee, we have numerous alumni listening to the broadcast tonight. Before we wrap up, I wanted to include a question from one of our alumni in Nashville. Tom Danforth wants to know, Professor Currie, is the banking crisis going to get worse before it gets better? And then we can wrap up after that.
No, I think it'll get better before it gets worse. Don't you? Don't you have confidence? You don't? You're a banker?
It cuts into my fiddler time, but no. I think that the issue is that you mentioned capital. Every dollar that a bank charges off reduces their capital by $1. Every loan they put on, they might only reserve a small percentage. So there's still some significant losses coming from the banks.
Okay. So a banker says it's going to get worse before it gets better, but I think it's going to get better.
I hope you're right.
I hope so too.